Hello viewers, today we meet again. Epic comes with informative insights. To those that have joined us before, welcome back. To those that are new to our programs, stay tuned, relax. I have my co-presenter who will introduce himself. My name is Denzel Ogamoyo. Over to you, sir.
Hello viewers, I'm pleased to meet you. My name is Shumba El for Lawrence, your associate in the Department of Accounting and Finance at Epic Network Group. Again, stay tuned, relax. Thank you.
Our focus today is on IAS 36, Impairment of Assets. Mr. Lawrence Shumba, can you please help us understand what is IAS 36 and what is impairment of assets?
Impairment is a process which ensures that assets are not carried at a value which is more than their recoverable amount. It is recognized under International Accounting Standard number 36, which is impairment of assets. For example, if I buy a bakery oven for 5,000 today and I expect it to last for 5 years, and then in year 3 there come floods which cause damage to the oven, and then I consult a technician and says it will last 1 more year and can only bake half as much, then that oven isn't worth 2,000 anymore. Maybe it will worth 900. So I have to write off 1,100 as impairment loss.
Okay, thank you very much, Mr. Lawrence Shumba. As they say, Olendlebe uzwile. So, why is impairment important for businesses?
Impairment is important to the business and its management because, firstly, it prevents overstating of a company's financial position. Secondly, it helps in capital maintenance. Thirdly, it helps for better decision making to management. And fourthly, it's useful for faithful representation of financial statements, which is one of the fundamental qualitative characteristics of useful financial information under the conceptual framework. And fifthly, and it's important for tax issues.
Okay, thank you very much, Mr. Lawrence Shumba. So, what are the assets that are applicable to impairment? Are all assets applicable to impairment, or there are some certain assets that are applicable to IAS 36?
So impairment is applicable on some of the assets, which include one, tangible and intangible assets, two, investment in subsidiaries, three, joint arrangement and associates. But it's also not applicable to some of the assets, which includes one, inventories, two, construction contracts, three, deferred tax assets, four, assets which arise from employee benefits, and fifthly, investment property measured at fair value.
Okay, thank you very much, Mr. Lawrence Shumba, for that. So, how can the individual identify the assets that can be impaired?
There are two major ways of identifying assets to be impaired, which include external sources of information and internal sources of information. So, under external sources of information, there is significant decline in asset value, two, significant changes in technology, economic, and environmental, legal environment, and significant changes in the market interest rates of the assets. Then, under internal sources of information, there is evidence of physical damage to an asset and also evidence of that economic performance of an asset is or will be worse than expected.
Okay, thank you very much, Mr. Lawrence Shumba. As we come to the end of our program, what are the key takeaways that you like to leave with our viewers?
So, for our viewers, they should take these key takeaways, which include test for impairment annually, and they should also kindly note that if an asset is impaired, there must be a new depreciation base. Then, two, they should assess the indicators of impairment at the end of at the reporting date. Then, three, if indicators exist, estimate the recovery. They should estimate the recoverable amount, which is the higher of an asset's fair value, less cost of disposal, and its value in use. Then, four, compare the recoverable amount and the carrying amount, which is the amount in which assets are recognized in the financial statement of financial position after deducting any accumulated depreciation, amortization, and accumulated impairment losses. The fifth one is record journal entries for impairment loss if the carrying amount is higher than the recoverable amount. Then lastly, they should disclose the impairment loss in the statement of financial in the financial statements as required by the accounting standard. Then lastly, but not the least, impairment loss can be reversible to other assets if they become valuable again, except for goodwill.
Okay, thank you very much, Mr. Lawrence Shumba. To our viewers, I do hope that you learned so much today. Epic International Consultants remains a home for every business sector. Follow us on all our social medias that are easier found at the website https://www.epicnetworkgroup.co. I repeat, https://www.epicnetworkgroup.co. Let's meet in our next episode. In that, goodbye.